Momentum trading has the potential to generate substantial profits for traders with the appropriate personality traits, risk management skills, and commitment to following the strategy. Executing the optimal momentum trading strategy can serve as an excellent approach to constructing and overseeing your trading account. Our team at Trader DNA is of the opinion that employing a momentum indicator strategy can help reduce risk and improve overall returns. We showcase this strategy in our comprehensive guide to the most effective trading strategies we've identified. Prior to delving into the best momentum trading strategies, let's establish the definition of momentum indicator trading strategies. So, what is momentum? The concept of momentum is borrowed from Newton's first law of motion. According to this law, an object in motion will remain in motion unless acted upon by an external force. This principle is known as the law of inertia. Imagine the momentum of a train. According to Newton's first law of motion, when a train begins moving, it starts slowly and accelerates. Once it reaches a certain speed, it maintains that velocity without further acceleration. This means that if a train is traveling at a certain speed, it will continue moving at that speed, unless something, like brakes or obstacles, causes it to slow down or stop. As the journey concludes, the train gradually slows down, but it requires a considerable distance to come to a complete stop. For a momentum investor, the most favorable phase of the train ride is when it is moving at its highest speed. Similar to the principles of physics, a market that is moving tends to continue moving rather than reversing course. This is why a momentum indicator strategy can be highly effective. Therefore, an asset that is rising is likely to continue rising. And assets that are falling are likely to continue falling. Essentially, trends tend to persist, and we can utilize momentum to determine optimal entry and exit points in trading. If there is a high or positive momentum and the current price is higher than the previous one, and the ascending trend is about to appear, then it is a right time to buy. Conversely, if there is a low or negative momentum and the current price is lower than the previous one and the descending trend is about to appear, then it is a right time to sell. Positive momentum in stocks often correlates with positive returns in the near future, while negative momentum tends to result in decreased returns. Hence, we have observed that momentum serves as a reliable indicator for scalping, intraday, and swing trading strategies. Now, before proceeding further, it's imperative to specify the technical indicators required. This will facilitate the selection and application of the best momentum trading strategy. Numerous momentum indicators exist, but the Williams %R indicator stands out as the most effective for identifying lucrative day trading opportunities. The optimal configuration for the Williams %R indicator in this trading strategy is 34 periods. The Williams %R operates on a scale ranging from -100 to 0. A reading near -100 suggests that the asset is oversold, indicating a potential buying opportunity. Conversely, when it reaches 0, it indicates overbought conditions, suggesting a possible downturn. Now, let's explore how to effectively trade using the Williams %R indicator. Our team at Trader DNA believes that intelligent trading is key to developing the most effective momentum trading strategy. Accordingly, we refrain from attempting to predict when momentum will occur, instead allowing the market to reveal its direction before reacting. A fundamental principle of the momentum indicator strategy is to buy high to go higher and sell low to go lower. Essentially, this means trading in the direction of the prevailing trend, while aligning with the momentum. Additionally, it's important to consider the hidden secrets of moving averages. Moving forward, we will outline the buying criteria for the optimal momentum trading strategy. Step number 1. Identify the trend. An uptrend is marked by a series of higher highs followed by a series of higher lows. The definition of an uptrend is fairly standardized. In an uptrend, we look for a series of higher highs, followed by a series of higher lows. 2 higher highs followed by at least 2 higher lows are sufficient to identify an uptrend. A higher high refers to a swing high point that exceeds the previous swing high, while a higher low is simply a swing low that is higher than the previous swing low. All momentum traders recognize that the trend is our ally. Therefore, there's no other choice. As a trader, you must accurately determine the current market trend direction. If you struggle to identify the market trend, such as a bullish trend, characterized by a series of higher highs followed by a series of higher lows, the most effective way, when combined with the Williams %R indicator, is to use the 200-period EMA and 50-period EMA. You can use any combination of EMA settings you prefer, but in my opinion, the combination of the 200-period EMA and 50-period EMA is the best for this strategy. So, in this case, if the 50-period EMA is above the 200-period EMA, then the Williams %R indicator reads the market as bullish. Step number 2. In an uptrend, look for markets with strong bullish trend conditions. If you have sufficient trading experience in forex, commodities, cryptocurrencies, or stocks markets, then you must have often encountered several markets that are in the same trend direction. This can certainly confuse traders in determining which market is the best to enter. My solution is to find markets with the strongest trend optimism levels. The way to do this is by observing the slope of the 200-period EMA and the 50-period EMA lines. If the 50-period EMA is above the 200-period EMA, and both EMA lines clearly show an upward slope, then the market is currently in a bullish condition with strong optimism. Now, it's time to shift our focus to the Williams %R indicator, which serves as the primary momentum indicator. This brings us to the next step in our momentum indicator strategy. Step number 3. Wait for the Williams %R indicator to reach oversold territory, or below -70, then rebounds above the -50 level before initiating a buy order. We'll employ the Williams %R indicator strategically. In an uptrend, we wait for the indicator to indicate oversold conditions, or dip below -70, then bounce back above the -50 level, before considering a buy entry. At this point, we receive confirmation from both the price action and the momentum indicator. Genuine momentum backs the trend, increasing the likelihood of further upward movement in prices. It's noteworthy that if the Williams %R indicator consistently remains in overbought territory, or above the -30 level, it signifies strong momentum and consequently, a robust trend. Conversely, the same principle applies in a downtrend. The subsequent crucial step is determining the placement of our protective stop loss. Step number 4. Position your protective stop loss below the latest high or low. We aim to conceal our protective stop loss beneath the most recent level of high or low that emerged just before the issuance of the buy signal by the optimal momentum trading strategy. Alternatively, you may opt to trail your stop loss below each successive occurrence of a high or low. This tactic enables you to secure potential profits in the event of an abrupt market reversal. Step number 5. Target profit at least 3 times stop loss. To increase your chances of profitability, you want to trade when you have the potential to make 3 times more than you are risking. If you give yourself a 3-1 reward to risk ratio, you have a significantly greater chance of ending up profitable in the long run. Use the same rules for a sell trade. Inversely, the same is true in a downtrend. Step number 1. Identify the trend. Downtrend is marked by a series of lower highs followed by a series of lower lows. The definition of a downtrend is quite standardized. In a downtrend, we look for a series of lower highs, followed by a series of lower lows. 2 lower highs followed by at least 2 lower lows are sufficient to identify a downtrend. A lower high simply refers to a swing high point that is lower than the previous swing high, while a lower low is just a swing low that is below the previous swing low. As I have already explained above, the most effective way to determine the trend when combined with the Williams %R indicator is to use the 200-period EMA and the 50-period EMA. You can use any combination of EMA settings you prefer, but in my opinion, the combination of the 200-period EMA and the 50-period EMA is the best for the strategy. So, in this case, if the 50-period EMA is below the 200-period EMA, then the Williams %R indicator reads the market as bearish. Step number 2. In a downtrend, look for markets with strong bearish trend conditions. If the 50-period EMA is below the 200-period EMA, and both EMA lines clearly show a downward slope, then the market is currently in a bearish condition with strong optimism. Now, it's time to shift our focus to the Williams %R indicator, which serves as the primary momentum indicator. This brings us to the next step in our momentum indicator strategy. Step number 3. Wait for the Williams %R momentum indicator to become overbought, or above -30. Then retreats below the -50 level before initiating a sell order. We'll utilize the Williams %R momentum indicator intelligently. In a downtrend, we sell once the indicator indicates overbought conditions, or climbs above -30, and then retreats back below the -50 level. At this point, we receive confirmation from both the price action and the Williams %R momentum indicator. Genuine momentum supports the trend, increasing the likelihood of further downward movement in prices. The next crucial step is determining where to place our protective stop loss. Step number 4. Position your protective stop loss above the most recent lower high. We aim to conceal our protective stop loss It should be positioned above the most recent level of lower high that formed just before the momentum trading strategy issued the sell signal. Alternatively, you may choose to trail your stop loss above each successive occurrence of a lower high. This approach enables you to secure potential profits in the event of a sudden market reversal. Step number 5. Target profit at least 3 times stop loss. To increase your chances of profitability, you want to trade when you have the potential to make 3 times more than you are risking. If you give yourself a 3-1 reward to risk ratio, you have a significantly greater chance of ending up profitable in the long run. As seen in the example above, we can conclude that this is a highly productive trading strategy for making money in both the forex, crypto, commodity, and stock markets. The combinations of indicators I have explained in this video can be manually applied as they are not difficult to implement. However, if you need these settings, I have already provided them in the video description column. I have included a template with a system that you can easily apply to your charts, automatically plotting all these indicators accurately. This way, there is no need for any additional complexity. Get the download link in the description. Here are other examples of the momentum trading to fully understand this wonderful strategy and to make the most out of it. Momentum trading entails a higher level of volatility compared to many other strategies. It aims to leverage market volatility for potential gains. However, if buying and selling decisions are not timed accurately, they can lead to substantial losses. Therefore, most momentum traders employ stop-loss orders or other risk management techniques to mitigate losses in unsuccessful trades. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or X to show your support. See you next time.